Welcome to Control Plus Q, where we discuss economics, finance, and investment from the perspective of high school students. Hi, everyone. In this episode, I talked with Isaac about stock options and futures and how they differ from regular stocks. And then what about like stock options? Like what's the difference between stocks and like stock options and futures and things like that?
Well, so stock options, yeah, so stock options, depending on how the context is, stock options are, if we're thinking about from more of a corporate standpoint, um, that's when your company, like if you start a company, Ian, and it like grows rapidly, and let's say you're like making hundreds of millions of dollars in profit,
Mm-hmm.
well, at that point, you may want to, if you haven't already, your employees or your key personnel, you may want to offer them like some sort of additional bonus incentive, which could be in the form of stock options. So this would be in kind of the publicly traded markets, but stock options from a corporate standpoint is essentially where you're allowing your key personnel, your managers, it could be employees, of course. Generally, it's for like upper level management, but essentially you're going to give them options um, based upon a bonus. So instead of paying, or not instead of, but you're paying a salary, but instead of paying a bonus in the form of cash, you can actually pay in the form of stock or stock options, which means, hey, you had a really good year. 2024 was like a great year. We're going to give everyone, we're going to take 10% of our profits and we're going to split them up into a form of a bonus, and the bonus is not going to be cash, it's going to be in the form of stock options. And the trade-off is like, it's like, oh, that sounds great, but there's generally a kind of a big trade-off, which is what we call as a vesting period. And the vesting period basically means you got to stay at the company for like 5 years until you can claim
Uh,
or exercise the options, and and hopefully the options are what they call is in the money. So the goal is like when you get these options, you're like, oh, this is great. It's worth something. But the purpose is it's supposed to align all the employees, all the managers, and all the people who receive them. It's supposed to align them in a way to say, hey, listen, we need to grow the business and continue to move it and grow it bigger and bigger, because if we continue to grow our profits, that's going to lead to a higher share price, which means our our stock options will increase in value because we'll be able to turn around and buy the stock at a much cheaper price. Uh,
mm,
so, like if our share price is $50, and 5 years from now we grow our company 10 times, and now it's let's say $500 a share.
yeah.
Basically, what we could do is maybe our strike, they call it a strike, but the price we can buy our shares are like $50 and five, but 5 years in the future, we're like, hey, we can buy it at $50 and the share price is worth 500. So
Mm.
we can actually turn around and make a $450 profit on each of those shares. So anyway, so essentially a stock option in the corporate setting is more for bonuses. If we're thinking of them from a kind of an asset manager slash trading, as a way to use for, as another form of leverage. We have calls and puts, and we can buy calls if we're bullish. We can buy puts if we're bearish. But stock options are basically it's what they call as a derivative, and a derivative is basically a fancy word for saying it's a product that derives from something else. Hence the term derivative, because it derives from what? And derivative, usually it's deriving from another product. So in the form of an option's a derivative. And where does it derive from? The stock. And well, what stock? Well, whatever the option is, if it's an Apple option, call option, well, it derives from the price of Apple, the price of the share of Apple. So um, there's all different strategies. I mean, to understand options would take a month to really get it down. But there are, me as a former options trader, there's the best way I can describe it. It's like playing a game of chess.
Right.
Each option strategy is its own chess piece, and you can do, spreads, basically debit spreads, credit spreads on both the call and the put side. You can use them for just plain old hedging. If you're shorting something, you can buy upside calls at the money. If you're long something, you can buy at the money puts to protect on the downside. That way, you have the right to sell the stock at a higher price when it's worth less. So I don't, not to get too complicated, but uh, options are a form of leverage, and they can primarily be, or they're primarily, they were, let me back up, they were primarily built to hedge. They are products used primarily for risk management. So essentially, they're kind of a form of insurance at the end of the day. So, and then you had asked about futures.
Yeah, futures as well. Yeah.
Okay, not to get into, it'll be shorter on this one. So futures, futures is kind of an interesting story. If you look back on the history of futures, it actually started, I think, in the 1800s, or the late
Oh,
1800s.
wow.
They were primarily helping for farmers in the same kind of, really the same type of retrospect. Essentially, is futures were really created around the commodity or the ag space, the agricultural space. Okay. So let's say you're a farmer and you are, your ag product is corn, right? And you're providing corn not just for us to eat, but for animals, for corn feed and so forth, right?
Okay.
So the way you make money as a farmer is you want the price of corn to be as high as possible, right?
Yeah.
Uh, well, what drives the price of corn? Well, it just comes down to two simple dynamics, which is supply and demand. So farmers from the east, all the way from the east coast, all the way from the west coast would come and meet in the middle. And that's why we know Chicago today to be the central hub and spoke of the commodities sector, is because it's the center of the country. So they
Mm.
came to the center of the country to say, listen, we need to do something about protecting the price volatility of everything from corn, lean hogs to cattle, cotton, sugar, coffee. They have one now for frozen concentrated orange juice. Um, so there's a number of different products, and it actually now extends into like even the financial markets, like bonds, and essentially index products like the S&P, the Dow, the Russell, the Nasdaq. So, but they were primarily built for hedging and risk management for farmers. So each product is a little bit different. They have its own specification. So corn is not the same as gold, not the same as silver. Price per barrel of oil is not the same as obviously cotton and coffee. So, but essentially, they're levered products, and you have to be very careful with them. So it's not a disclosure, or this, I should just say, this is a disclosure to say don't trade them. Okay. Obviously, if you know what you're doing, that's a different story. But uh, put it this way, there's been stories I've heard when I was probably your age, maybe a little older, of hearing young young adults in their 20s or something trading these futures products. And I think there was one where a kid, how many years? This is probably like 15 years ago, but he was trading like cattle futures or so, and
Mhm.
forgot to close out the contract. And basically, he had the SIBO, I believe, or the Chicago Mercantile Exchange, CMEX. Can't remember which one. They had mentioned they had set aside a bunch of cattle for him. He had to go pick it up, and
Mhm.
he's like, "What are you talking about? I'm not picking up cattle." So, but that's the agreement. Like you can basically these products, there's financial, they can settle from a financial standpoint, or they can settle in the actual commodity itself, like they call it physical. So if
Mhm.
you're not careful and you're trading the wrong product, you could have cattle waiting for you, or you could have copper waiting for you, lumber. So yeah.
Oh, I see.
Yeah, so anyway, just to wrap this up, but futures are it's a leveraged product as well, but it's really meant for really companies that have exposure to the commodity space, and it could be metals, but it's again, it was primarily used and still used today to hedge a lot of commodity costs because I think cocoa this year was skyrocketing, and it's hurt
Oh,
Hershey quite a bit, Hershey chocolate. I think cocoa prices are, I think, slowly coming back down, which will push the price of, which should push the price of Hershey back up. So
oh, I see. Okay, so futures are more grounded in like commodities and like more physical like objects or like goods, I guess.
yeah, they are primarily for those, but at 2024 they have I mean, now there's like a cryptocurrency future,
Mhm.
or excuse me, a Bitcoin future. So
Mhm.
there is, but there's futures products on a lot of different things now. So like if you're running a hedge fund, and you want to use futures to hedge, you can, like, let's say you could short, like, let's say you're a hedge fund manager that has a bunch of S&P 500 stocks in your portfolio and you're a little bit nervous about X, Y, and Z. You could go out and short S&P 500 futures, or they call them E-mini S&P 500 futures. And that, depending on how big your portfolio is and your delta, or excuse me, your delta movement, you
Mhm.
could short X amount of futures contracts to kind of like offset your long deltas with short deltas. So not to get too in the weeds, but it's kind of like if I push forward, something else can push backward. Or excuse me, I would say if I'm pushing forward, someone else can push against me. That's kind of like a hedge, right? Is my portfolio can move up and down, but if I have something moving completely inversely to that, then I've basically created a neutral portfolio.
That is all for this episode. Thank you for listening, and I will see you next time.